Welcome to the OIR Quarter 1 2023 results. In the posting, it also stated that there were the 2022 financial results. I want to let everyone know we did go through that in our first quarter meeting. We are in the second quarter of the year now. However, we did just receive our final annual filing with the Office of Insurance Regulation, as well as our audited financial statements. So those have been filed in the libraries on the 5th floor of both Gables East and Gables West, provided to both the Finance Committee and to our resident council president. So if you would like to review those results, you are more than welcome to go up and view them in the library. Nothing really changed materially from the presentation in the first quarter to the audited financials, and so as a result, we're going to spend a lot of our time in the first quarter of 2023 because I do feel that this is the proper place to be living. Why live in the past when we can live in the current past? So we will go over our 2023 first quarter results. I have a different format than I have had in years past. In years past, there's been a quick one-sheeter kind of going through here's what happened, here's where we're at. I thought a PowerPoint would be more appropriate for this meeting. It just gives you guys a little bit more information than what we provided before. I do have, the Finance Committee does have the detailed version of the reports that are quoted here. They are provided them monthly. So they are seeing our monthly financial reports, and that's where all of this information came from. So they are well versed in kind of how we're doing year to date. So we are going to start with me hitting the right button so that I can get to the next slide. And that slide is to go over our occupancy. So for those that were in resident council, this morning we talked a lot about occupancy and kind of where we were as a property. So typically what I would present at this time would be our average daily census, which is a number that we look at. But what I have in this presentation here is these are the number of people. So apartments and people as of March 31st, so the end of the quarter. Because when we report into the Office of Insurance Regulation, we do not report our average daily census. That is our tracking number, that is our mechanism to see how well we're doing. We report our census as of a snapshot in time. So that snapshot in time is always the last day of the quarter. So in March, as of March 31st, we did have 275 of our 416 independent living apartments occupied. So in independent living, we had a 66.1% occupancy. The total residents are 358 because we are comprised of singles as well as couples that live here. In our assisted living, we were at 100% occupancy, so we had 76 apartments rented of 76 apartments available, and we had 76 residents. So that kind of worked out. In memory care, we had 47 apartments rented of 48 available apartments, or a 97.9% occupancy. For those that are not aware, we did have one apartment that is not able to be rented right now. It was damaged in the hurricane. As soon as we get the permitting to fix the exterior windows, we will be going in and fixing that apartment. Once that is done, then that apartment will again be available to rent. So even though we were sitting at 97.9% occupied, we did have 100% of our available units rented at that time, and we did have 48 people living in memory care, so we do have one couple over in memory care. In skilled nursing, our occupancy was 92, so we had 92 beds that were occupied of a capacity of 104, so we were at 88.5% occupied and a total of 92 residents. So then our total occupancy at the end of the quarter was 490 units rented of a capacity of 644, so we were at 76.1% occupied. And if you can see from this chart, yes, our greatest opportunity right now is in independent living. So we are working right now on different strategies to drive our occupancy. In independent living, I was discussing with the Finance Committee earlier, it's kind of twofold strategy. One is a normal property keeps up with the attrition of its existing residents. So we are part of a continuum of care. So we do have residents move out from time to time to go to a higher level of care. We do have residents who pass away, unfortunately, and then we do have residents that move out. For those that are wondering, of those that move out, our #1 move out reason is moving closer to family. So a lot of residents that moved to Southport Square came here after they retired, so they did not live in Punta Gorda as they were raising their families, and their families live elsewhere. We do find, especially in a couple, that if one spouse dies, a number of our move-outs are the other spouse getting pulled back by their family to be closer to their children or grandkids. We also find too, as residents are getting ready to go through that continuum of care, that their children or grandchildren want them closer so they can visit them or help take care of them. And as much as those contract benefits are unequivocal to what you can get elsewhere, we do have residents choose to be closer to family. So that is truly our #1 move-out reason when we have our voluntary move-outs. So there is the need to keep up with that attrition, and then the twofold which we're trying to tackle now is how do we grow that occupancy while keeping up with the attrition, which means that we need a lot more volume coming through Southport Square. We were discussing earlier our biggest success in having people move in and want to be here is the referral program. So please remember, if you enjoy living here and waking up here every day and you have lots of friends outside of here, we do have the Friends for Life referral program. We do rely heavily on your recommendations and your referrals to help us grow occupancy, so please don't be shy. When we look at our performance, and this is new to all the residents that are here, we look at we call it our net attrition or our net cash position for contracts coming in and contracts that are being canceled. So if we look at our quarter performance, the first thing we have is we have our entry fee closings. So in the quarter, we closed 13 contracts with an entry fee this year. We budgeted to close 11, so we did outperform our budget by 2, or we did 18% better than our budgeted expectations. For our entry fee refunds, we had projected to refund about 9 contracts, and we refunded 11, so we overperformed our refunds by 2, or 22%. When we are looking at our refund dollars and our entry fee dollars, history is our biggest indicator of how we're going to perform. Not only is history an indicator, but also from an entry fee standpoint, our available apartments are an indicator. So if you look at our average entry fee, which is the last line, you will see that we expected to get about $205,000 worth of entry fees from every contract that's closed this year, and we're sitting around $134,000. That's about 35% off, or about $72,000 per contract. When we look at that though, we have to look at what did we think versus what are we actually doing. So yes, we did close 2 contracts, We did close 2 contracts above our budgeted rate. However, this year we are selling more 1-bedroom apartments and studio apartments than we did in prior years. So of these sales, we sold 2 studio apartments and 8 Captiva, which are our small 1-bedroom apartments, which means that they have a lower entry fee rate. So it's not necessarily a volume. Our volume's not an issue. It's with the rising interest rates, with the slowing housing market, we are finding people that want those smaller units rather than the larger units. They're a little less risky or more risk adverse. And so they're choosing those apartments with that lower entry fee. And then we also sold 2 contracts, which were a choice no life care. So those that are familiar with that, that is our contract type that does not afford the life care guarantee, has a lower entry fee, and has very limited healthcare benefits. And we did have 2 residents opt for that choice no life care program rather than entering into a full life care contract. So of course that does drive a lower entry fee. When we look at our refunds, our average refund dollar is almost right on the mark. We're off by 284 or 0%. That's the best budgeting you'll ever see me do in my life. I'll never repeat that again. But that being said, our volume is a little bit higher. For those of you that don't know, our budget season and when we are planning all of this occurs around July, August, September of every year. So in July, August, and September, we kind of guess what do we think we're going to do for the rest of the year. and what do we think next year is going to do. What we didn't think is we were going to get hit by a Cat 5 hurricane. At the time we were doing budgets and how that would impact us. We did see in the fourth quarter a larger number of move-outs. Those move-outs were not voluntary. We had a larger number of residents transfer over to the healthcare center just because their needs increased, and we actually had quite a few residents pass away, unfortunately. As a result, what that did is it drove a higher refund dollar liability in the first quarter. So that's why you're seeing our refund numbers a little bit higher. We also had some rather longer term residents leave us, unfortunately. They passed away. Back 15, 20 years ago, we sold more 50% refund contracts than we do today. Today, most of our contracts are 0% refund because the 0% refund allows for the resident to invest their money and get a rate of return. It's just a change in preference and the change of times. But when our tenured residents pass away, it does drive a higher refund liability. So while we hit the regular average refund, what we did not account for was the number of move-outs that we were going to have. The good news is we did end the quarter at our budgeted occupancy, so even though we had an increased number of move-outs, our sales team, God love them, were able to outperform to enable us to stay at our budgeted level. So. When we look at our revenue, we're looking at our performance, and this is what the Finance Committee gets every month, kind of how we're doing. This first section up here where it says RevPOR, that's our revenue per occupied unit. So that takes all the revenue. Bistro, guest meals, guest suites, your monthly service fees, any discounting, any type of credits we may give you, any hardships, and it rolls it all up and it compares it to our occupancy, and it tells you here's where we're at as far as the average revenue that we're getting per our occupied unit. So if you look at where we're at right now, we are almost at budget in independent living. We're within 1% of our budgeted realm. So we budgeted $3.48 million. We came in at $3.44 million. And again, our average per revenue came in only $7 off from what we anticipated. So we're performing as we expected in independent living, which being the times that we had to face in the first quarter and the fourth quarter of last year with the hurricane and the first quarter in the recovery is pretty darn good. You know, we still don't have all of the services like guest rooms where we have budgeted dollars, but no guest rooms available because we have our residents floating in as we're doing hurricane repairs. So we're making up for it in other ways. So it's been a good story in independent living. In assisted living, we looked at a budget of $1 million and we're performing at about 1.1. If you look at their average revenue per occupied unit, we're running about $150 or 3% more in assisted living. That entails two things. Number one, we are beating our occupancy in assisted living to what our budgeted levels were. We're about 3 or so a month over what our occupied or what our budgets were. But we are also getting more per unit than what we had anticipated. After COVID, for those of you that had been here for the last 3 years, you will know that before COVID, our assisted living and memory care ran almost full all the time, not quite full, but almost full all the time, sorry. And then COVID hit, and when COVID hit and visitation stopped, people stopped moving in, people started moving out, people passed away, and we went from an average census of 72 to an average census of 53. So back to strategy and how do you build back up. We did offer discounting in our assisted living. We got us full. We stopped discounting, we stayed full, and we're still there today. So as we see this revenue growth, that revenue growth is coming from community move-ins because we do have the healthcare benefit on the side of the residents. So the residents don't necessarily pay as much as the community move-ins pay, but we are consistently full in memory care, and that's a very nice thing to see. Memory care is the same exact story as assisted living. Same with COVID. We really struggled in our memory care census because people didn't want to move in their relatives and not be able to see them or visit them. As we're getting out of that COVID period and now the public health emergency is over, life is kind of getting back to normal. So our memory care stays full almost all of the time at this point. We are outperforming, both on an occupancy level and on our revenue per occupied unit level. And again, that's attributed to our wonderful sales manager, Christina, who does not like to see an empty room, and has a great network of community referrals and is able to keep our memory care and assisted living full while not sacrificing any of our independent living residents that need assistance. So you guys always get priority and are number one in our eyes as far as needing to move over there. Skilled nursing is probably right now where we have the biggest opportunity from a budgeted perspective. So in skilled nursing, we are definitely seeing a hit in our occupancy. If you look in the last line here, under average occupancy, we're missing by 9. That was just year to date, but skilled nursing has our highest dollars of revenue. So when we look at our skilled nursing, we are off in our revenue by about 10%. That equates to about $334,000. And our skilled nursing revenue per occupied unit is off by about 1%, which is $106 per day per unit. In skilled nursing, we have a little bit of a conundrum there. We are trying to manage fiscally sound and bring in people that need assistance from a short-term rehabilitation standpoint through Medicare and their managed care stays, and we want to make sure they have a safe place to go when they discharge from here. So be it home, be it their independent living, be it our skilled nursing. So we do have a balance that we have to do between the staffing levels that we can create safe care for them, and then bringing people in to where we're not overwhelming those staffing levels so that we lose people. So for those of you that know, we are still using contract nursing in our skilled nursing. Our goal is to have them eradicated by July of this year. We have been working diligently. We take 2 steps forward and maybe a half or a step backwards, but we are still working on that as well. But we do have our biggest area of opportunity. The good news here is that we are looking to be almost at budgeted levels this month, and if we continue the occupancy levels that we have for the last 2 months, we will exceed our budget for the rest of the year. So we are seeing a light at the end of the tunnel in skilled nursing. We've been able to increase our staffing to allow us to continue to increase the number of people that we can have in skilled nursing. We're sitting at 95 today, which is a wonderful increase from what we saw about a year ago when we were sitting in the high 80s. So we are continuing to move in the right direction. Our innovative home services, therapy, and other operating income kind of rounds out the rest. From a dollar perspective, we are performing well. Therapy is not what you think of as our therapy department over in Harbor Health. We had a small budget for outpatient. However, since they are now outsourced, we're not seeing that revenue stream. Honestly, from where it stands right now, our innovative home services is really picking up the lion's share and helping us to overcome that small budget deficit every single month. So don't expect that to cause any issues. And then other operating, where we're doing 15,490% better. Never seen that big of a number, or $43,000. That is for apartment upgrades. So when we look at us accountants, we try and make stuff as difficult as possible. So when we do upgrades on apartments, even if it's resident funded, those upgrades have a life expectancy. So the revenue or the money that you pay us to do those upgrades, we amortize over the life of the contract. However, if you were to move out before we earn all of that revenue, then we take it all at once because that resident's no longer in that apartment. So that $43,000 is a true up. They do this once a quarter, and they did a true up because of the fourth quarter move outs. Honestly, we had a lot of residents that moved out that we had not fully earned their upgrades. So as a result, we saw a win in our other revenue column. Any questions? All right, so as I move to our expenses, our X4, just for those of you, we like our acronyms. That's our expenses per occupied unit. So that's our expenses per every unit that's occupied, regardless of levels of care. I can tell you skilled nursing has a higher X-score than some in independent living, because when you're in skilled nursing, your expenses include your care as well as your room and board. However, when we're looking at this, we are performing to our budgeted level. We're about $96 off, but not too bad. When we look at our salaries and wages, I tell people our single highest expense and our single highest asset in this place is our employees. Our total salaries and wages are coming in at budget. They're coming in at budget, not because we're full. I'd love to say we were fully staffed, but we're not. But because we are using contract nursing tends to be quite expensive, which is why we're looking to have them replaced with our in-house nursing. We were going in the benefits of, can you pay the contract rates? Just so you know, contract nursing, for the most part, when you're paying them that higher rate, what they're not getting are the things they can't touch, see, and feel. So they're not getting their benefits. They don't get anything paid into Social Security. They don't get workers' comp, all of that stuff. They are truly 1099 vendors. So they do contract with a company, that company pays them a higher wage, but they are responsible for everything else themselves. So it is trying to get sometimes that younger generation, they're not always younger, but that information to that associate that yes, it's not the same take-home pay that you're getting today. However, we're offsetting some of your tax liability. You don't have that big check you have to write to Uncle Sam every April, which is about where they're at right now. We have benefits, we have paid time off, we have workers' comp, we have FMLA, we have things there for your protection. Tammy, our healthcare administrator, does a very good job of educating staff that like it here and that we like having here, and has converted quite a few contract labor nurses that seem to work here full-time because they like picking up shifts here. So she does a very good job of identifying them and, as you've heard Brian say, loving them up and getting them transitioned over to Southport Square staff. So that is one way we're working on recruiting, aside from other recruiting efforts, to make sure that we stay fully staffed. So while it does look like we're sitting at budget, we're paying a higher rate for contract nursing. We do have probably about 50 to 52 open positions around campus for full and part-time. That is quite a lot, but the good news, as Brian was saying in our call the other day, we have the highest number of employees today that since COVID hit. So we are almost back to pre-employment levels pre-COVID. I will honestly tell you, since the day I set foot at Southport Square, we've never been fully staffed. Since the day I set foot at Comcast in the 17 years I worked there, we were never fully staffed. The idea of saying that a company will be 100% fully staffed is nice, but you always have people coming and going. So the only thing we can hope to do is grow, continue to keep them. We are in the top 5 of the lowest attrition in the entire portfolio. So we are definitely seeing improvement on our attrition, and we are seeing more people come in every day. We've actually moved our orientations to weekly rather than bi-weekly, and we have 5 to 6, sometimes more, every single week in orientation. So we are keeping busy, keeping people in here as fast as we can. When we look at the rest of our expenses, I'm going to just call out kind of the outliers right now with non-utility expense. For those of you that have been peppered with Dawn's, and we're bringing the water down again, and we're bringing the water down again.
It's not my fault.
Memos, it's not her memos. But we have actually spent around $56,000, I think, year to date. That includes April in plumbing repairs. So there's a reason we're bringing those down, but that's also a reason why we're over in utility. We also had a budget error, and the only person I can look at is myself. Since I don't have a mirror, I'm not going to do it. But we do have a budget error in our disposal costs. So we are running over our budgeted level. And that is why we're running over. Those are the 2 main reasons we're running over a non-utility expense. And then in food and beverage costs, we are still paying an exorbitant amount in to-go supplies. We probably spend $12,000 a month in those lovely little containers that go in the garbage. So we are doing a couple of things. Please, 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 please reuse the green ones. Please put them in the bins. We can replace those every 3 months versus every meal, and that's a huge difference. And we are getting ready to launch dishes in the bistro. We're working on a solution for a dishwasher in the bistro. That will take us a little bit of time, but we are working to get the bistro out of the 100% to go, so to go will only go if you go, and work to get dishes over in there. They're not gonna be China. They will be like a melamine, but they'll be a higher end look, and going back to silverware there as well. So bear with us as we get ready to make those changes. But all of that is going to be done to try and reduce those costs of buying supplies to have them thrown out. And again, if I can't stress enough, if you have the to-go containers in your home, please bring them to the bins, please give them to dining, please bring them when you come to dinner. We do wash them, sanitize them, and reuse them, and we can replace them every 3 months versus every single day. So it will help us control those costs so that we can spend the funds in a much, much better place. I'm off the soapbox now, sorry. And then if you look at assisted living, we are running over about $8,000 in expenses, but if you look, assisted living really, from an operating standpoint, doesn't cost all of that much. That is mainly due to a program that we do provide in assisted living and memory care, and that program is called Personal Solutions. And what Personal Solutions is for those of our residents that may need incontinence supplies, they are required to provide them. So we have a program where we will order them for you. It's a monthly fee. We monitor, maintain, and do all of the ordering. So those expenses are truly offset by revenue. So while it looks like we're over, there's a direct correlation to that Personal Solutions program. The reason we provide this is it then takes the family members out of having to worry about whether or not they sent it via Amazon or dropped it off if they live in town. And we take the ownership for that program for the resident. So altogether, if you look at our controllable expenses, we are over year to date by about $86,000. Again, with those leading drivers being our plumbing leaks, our to-go containers in food and beverages, and then our disposal costs. When we look at our non-controllable expenses, I always tell people, they giveth and they taketh away. Our management fees are solely based on revenue, so once we start recouping those revenue dollars with our occupancy, those are going to go back up to budget. They may even exceed budget. Right now we're performing well to budget, but that's because revenue's off. So I always want to overperform on that one. And insurance and taxes is a gift. It's either a gift that giveth or it's a gift that taketh away. What we see in our insurance and taxes, aside from our personal property taxes, is our, it's called an IBNR, which means incurred but not, gotta think about this one, recognized. So what that means is we have pending liability cases, whether it be workers' comp, whether it be general liability, or personal liability cases that are out there. And we have those experts out there that say this is going to cost you this much money. And so we reserve those funds. This is trued up twice a year. It's trued up in February and it's trued up in October. And based on what's out there, that reserve hits us. So it's either a good guy or a bad guy. We don't control it. It is controlled by Health Peak. As much as I would like to say we control it, why it's in the non-controllables. But I never take that good guy as a good guy, because as quickly as it came is as quickly as it can go, depending on what's going on. I can tell you from a workers' comp and a liability standpoint, that is something we take very seriously, and we're actually doing very well as far as our performance to expectations. So that's why we see a good guy right now as far as $85,000 in that category. So that brings us to our net operating income. So a lot of times you guys are gonna hear me say, the top one is the real one, and the bottom one is not. The reason why I say that, the top one, you'll see our total operating expenses and our total operating income and our total operating expenses gives us our net operating income. That's our gauge on how we're doing on our day-to-day life at Southport Square. So what that does not take into effect is any unearned entrance fees, any amortization revenue and or expense, any depreciation, anything like that. All of that we call a below the line revenue or expense. So this truly is how every single day that we show up here today to do our jobs, to provide for you all of the experiences, the dining, the maintenance, security, how we're performing. So if you look at how we're doing, our budgeted expectations, and I know this is backwards, sorry, was $532,000 net operating income, and we came in at 418, so we're missing by about 115. Now going back 2 slides ago, you'll see that we missed our skilled nursing revenue by $332,000. And we did say here, occupancy is king. You know, it hides a lot of errors, but it also, you know, makes or break our NOI. We can pinch and save money only so far, because what we can't do is not provide services to you all, not provide food, not provide maintenance. So we only get so far in cost savings, and the rest of it has to come from occupancy. Now the good news is we're missing by 114 quarter to date, but our skilled occupancy right now, if it stays where it's been trending for the last 2 months, for the rest of the year's budget, we're gonna be just fine. Not only would we be just fine, we'll most likely be overperforming. So as a result, this does not mean we're not making money, so please don't take this to say we're negative as far as our performance goes. We're just not meeting the promise that we made as far as our financial obligations to our ownership. If you look, the total other income and the total other expenses, that does include things like unearned entry fee, that's considered other revenue. That does include our amortization and depreciation of our property, plant, and equipment. And so that all factors into what our total net income or net loss is. And so if you look, our net income, when you factor in all of that, is a budget of negative 1.5 million of a net loss to an actual net loss of 2.4 million, or missing by $892,000. There's 2 contributing factors to this. Number 1, our budgeted net income or net loss is a net loss, because if you remember back in 2016, we refinanced the property here, took a mortgage on the property. The mortgage is with HealthPeak, which is our ownership, but we are still required to pay our ownership back. So a lot of that other expense includes our interest on that promissory note or on that mortgage that was taken out. The second thing is a little 3-letter word called Ian. We do have all of our hurricane losses that are not considered a building improvement. So our roof's considered a building improvement. The landscaping is considered a building improvement. However, there's a lot of other things that were intrinsic that were just repairs. So we had to repair broken doors, broken Gables West hood system was broken. Those are considered expense. So while our expectation is around a $10 million loss from the hurricane, part of that is going to flow into our expense line. That flows into the other expense line for us. It doesn't go into our operating net income. It just goes in below the line as an extraordinary loss of the hurricane. Some of that will be offset once our insurance company pays us. So we incur the expenses as they happen, and when we get the reimbursement back from our insurance company, you'll see a credit hit that line in that month. The same thing happened when we did the roofs back in our hurricane prepared days of when we had that windstorm in December, to give us a preview of what September was going to look like. So some of that will come back, but that is absolutely why that net loss looks a lot higher than what we had anticipated from a budget standpoint. the last piece is our balance sheet. And this is just more informational purposes, just so Mr. DeWitt had asked to look at the balance sheet. We were provided it with the OIR reporting, but I wanted to put a recap on here so you all could look at kind of where we were at. Currently, Southport Square holds about $10 million in current assets, and those current assets are our accounts receivable, or all of the money that is owed to Southport Square by our residents, our cash and cash equivalents, our minimum liquid reserve. So our minimum liquid reserve is around is about probably 103% of that $10 million total, and then our prepaid expenses. So our minimum liquid reserve, we are required by the Office of Insurance Regulation to keep in a separate account that Southport Square cannot use for operating a minimum liquid reserve. And what that is that is an amount to be kept aside in case of receivership or bankruptcy on Southport Square's part, so that Southport Square can continue to operate. We're nowhere near that, but it's just required. We have to keep it there. The minimum liquid reserve is calculated every year with the annual OIR filing, and right now our minimum liquid reserve stands at $11 million. So that sits in our current assets. So offsetting that is a lot of our prepaid expenses. It's a negative line, it's going to subtract from that. We do have accounts receivable, so we do have funds that are owed to us that is in there as well. But the reason why it looks like we have a lot of current assets is because that minimum liquid reserve sits in a separate bank account, and we do have to approve funding every year, all year, and then is reevaluated at the end of the year. The non-current assets, and I'm sorry I have liquid reserve in there twice, but that's not there, of $177 million, I forgot a comma. What that includes, that's our property, plant, and equipment, that's our building, that's our depreciation. So when we look at the entire property, everything in it, that's considered our non-current assets. So Southport Square has a total asset base of $187 million, which includes all of our receivables, our minimum liquid reserve, our PP&E, our property, plant, and equipment, all of our furniture, fixtures, etc. Then when we look at our liabilities, and what are our liabilities? We have about $5.9 million in current liabilities. That's any outstanding account payable that we may have, any accrued expenses, so expenses we're expecting but haven't been billed for yet. Our current portion of any notes payable, the mortgage being the biggest one that we have there, and then any short-term liabilities that we may have. Our non-current liabilities of $36 million includes any refundable entry fees. So any entry fee contract that has a 50% refund clause in that, we keep those in a non-current liability because that is not our money to spend. And then we also look at a percentage of all of the 0% refundable contracts, because for those of you that may have closed recently, you will know that we earn that over a period of 47.5 months. So anytime within that 47.5 months, there is a refundability on those contracts until it hits that point in time. So we do keep a reserve, assuming that not every non-refundable contract is going to hit that 4-year mark. And then we have deferred revenue from entry fees. And again, as we earn these entry fees, they move from our liability to our asset, but as we're deferring that revenue, it does sit in our non-current liability. And then we have our net assets and equity. So this is just to show we do balance our balance sheet. It does balance, so a balance sheet in accounting terms is you take your assets, and your assets should equal your liabilities plus your net assets and equity. So that is done every month. We do provide it to the OIR every quarter, and then the Finance Committee will receive it every quarter as well. So what does that mean for us? It means a lot. Our biggest thing is staffing. Again, aside from occupancy, which I'll get over in a minute, but our staffing stabilization, it is good to know we are back to pre-pandemic staffing levels. Not exactly the same staffing levels as the pre-pandemic, but we have the same amount of employees or more. We are going to continue to look at reducing that staffing agency and moving towards eliminating them. We would rather our associates serving our residents at every turn. We are looking to still, even though we're in the top 5 of the portfolio, improve our retention and decrease our turnover. In this day and age, it is a very different labor market than when I started. When I started as a professional, you never thought of, I don't know if you've all heard the term ghosting, but ghosting an interview where you set up an interview, you say you're gonna be here at 10, and not only do you not show, but you don't call. And then you don't answer the phone calls that they call you back on, and you don't return the text messages. That is unfortunately a common practice nowadays with not just entry level, but with professional positions. There was a study that one of my HR professionals in my last job had said that millennials make up their mind within the first 7 to 14 days if they're gonna stay at a place. First 7 days here, you spend 2 days in orientation, 3 days on Relias, which is a computer educated training. It's very hard to woo someone in 5 days. So we have to make sure that we're touching these employees often, regularly. We have to make sure that they know we care. And when they make up their mind, they're gonna go. There is very low unemployment in Charlotte County, especially in the service industry. And there's a lot of growth in Charlotte County. In the budget presentation alone, we have Sunseekers opening up in September of this year, 1,200 jobs. We have a huge, and I never remember the name of the establishment, they have one in Tampa, but it's gonna build a beachside dining right across the street from Sunseekers, where it's gonna be beachside dining, so they're gonna come in, they're gonna build their own beach, build their own boardwalk, and have inside-outside dining, and they're coming in as well. So that's gonna be another couple of hundred jobs in the service industry. Charlotte County is growing, unemployment rates are not. So we have got to make sure that our employees feel valued every step of the way. So we are constantly looking at ways to improve our retention and decrease our turnover. And then last but not least is implementations of wage adjustments. We do have the legislative wage adjustments that is gonna move the minimum wage to $15 by 2026. We are ahead of those right now, and the reason why we are ahead of those right now is because we have to continue to be competitive in our market. A lot of people, the advice of keeping their employees is to pay them more. We do, and we're constantly evaluating that. But when we raise our rates, so does our competitor. So then we raise our rates, and then so does our competitor. So we've got to get better at those connections, those untouchables that make people want to be here, that make people want to stay here. And that comes from us to those associates, so they realize how valued they truly are. From there, our focus is on our census and caseload focus for the healthcare center and IHS. Those are 2 areas of opportunity for us, aside from independent living. We don't just look at the IL when we look at opportunities. So those are some things that we're looking into now, and how can we better optimize that. Good news is that doesn't deal with any of you, so we're not gonna be looking at you to help us optimize. But something near and dear to everyone's heart is that IL inventory management. Is we've got to get better at growing our occupancy, and how do we do that? How can we turn these apartments quicker, better, faster? How can we grow as well as maintain? So we're going to be running almost 2 different plans here to get Southport Square to get up to that industry average, I believe around 87%, and to get us there. So that is something that we are absolutely focused on right now and spending a lot of time doing to see how we can get our occupancy levels up. And then from there, departmental expense management, much to the department head's chagrin, they still have to deal with me. And as we do things those not make occupancy, it's how do we strategize, how do we reduce the impact of the inflationary market that we're in right now to our residents, and how are we still able to provide services. And I was talking with the finance committee earlier, dining being one of them that's near and dear and personal to everyone's hearts here. And what are we doing? And one of the things the dining team is doing right now is we're kind of going back to the basics. We've hired a lot of people in the last few months. They need a lot of training, and we're working through that. And we don't expect you to bear the brunt of that in any means, but this year our theme is getting back to the basics and building a program so that within 2 years, the dining program that you see today is completely revamped and hopefully much to your surprise and to your pleasure. And we are using resident feedback and running things through the dining committee and giving them kind of where we're thinking of going so that we're not doing this in a bubble, so that we can provide better services, provide great experiences, and that's just not in dining, it's in dining, it's in activities. Lord knows I don't know how Smita does what she does, but and making sure that when you move here, it is truly like a cruise ship on land, as I've heard it referred to. So that's what we're going to, and strategizing to make sure that you all don't feel the brunt of those inflationary pressures, minus the annual rate increase, because that's not going away. But how do we still give you guys the quality programs, the quality experiences that you want? So that's what we're working on now. So that being said, as I said before, for year-end results, we did go through them last quarter. However, they are now available upstairs in the 5th floor libraries. There you will find our balance sheet, our statement of operations, the statement of cash flows, and our audited financial statements. As I said, they have been provided to the Finance Committee. If you ever need a reason to beat insomnia, I would say go check it out and look at it and try and read it, because it will cure it like that. But truly, we do believe in transparency. The OIR has granted you all the ability to be afforded that transparency. So if you ever have any questions, I am located in Gables East. Please don't hesitate to come and talk with me. And you also have really good Finance Committee representatives, Mr. Jackman and Mr. DeWitt and Mr. Nicky Tuck. So please feel free to go and speak with them if you have any concerns.